Hi, this is Professor Prusha. I'm going to spend a few minutes and go over some of the highlights of Chapter 1. In a separate video, I'm going to go over some of the time value of money concepts. In this video, I'm just going to cover general ideas in Chapter 1. The way to think about how the course is set up is there are 8 basic financial planning activities. And chapter 1 is thinking about financial planning and thinking about the idea of goal setting. As you can see on this slide, we'll spend a couple weeks thinking about the planning process. We're going to talk about savings issues. Then we'll have a chapter about borrowing issues. We will do chapter 6 and 7. Sorry about that. Chapter 6 and 7 will be issues on spending. In particular, we'll be thinking about major expenditures like housing and cars and things like that. We'll then do several chapters on managing risk, aspects of insurance, and then we will do several chapters that I view as just the basics of investing. We'll talk about stocks, mutual funds, and general ideas of investing. And finally, we'll conclude by discussing some issues involving retiring. If you do the planning, saving correctly, along with investing and managing risk, your retirement planning will be considerably easier. One of the things that is discussed in chapter 1 is the idea of goal setting, and things that influence your goal setting will be items like your current age, your marital status, the number of household members, and your employment situation. We're also going to talk a little bit about time frame for setting your goals, short, medium, and long run. In a couple slides, I'll talk about macro issues and family-specific issues that would influence your planning. And then a big part that you'll see echoed throughout the class is this issue about values. So part of good financial planning is really identifying and thinking about social and economic influences on your personal financial decision making. This a lot of pressure from marketing people in society to change purchasing decisions. You need to come to grip with the idea that your own personal values influence your purchasing and savings decisions. And what I want you to learn in this class is consequences of those decisions on your financial life. I'd mentioned that one thing that influences your planning is your age. So on this slide, here's a rough idea of how you might think of your life cycle in terms of planning. So I kind of consider up into your mid-20s a period of time where mostly what you're doing is investing in schooling and education. I think this describes most, perhaps not all of the students in the class, but you're in a phase of your life where you're building up human capital and schooling. That probably also means for many of you, you're accumulating some debt because college is expensive and you'll need to pay that off then. Early in your job career, I have here age 25 to 34, you should expect to have a series of what I call initial jobs. I want to emphasize the plural of that, jobs. Historically, as in the 1950s and 1960s, many people, their first job was their only job. That might be because they were working for Ford on an assembly line or U.S. Steel in a factory, or just more generally, workers had long job careers with the same firm. That's no longer the case. The typical person has approximately 10 jobs in their first 15 years of work. So this could be viewed as either positively, that as you get jobs, you meet new people who want to hire you, or you develop more on-the-job skills that allow you to move to something new. On a negative, it could mean that you're having a hard time holding a job. I'm going to tend to focus on the positive, which is you need to learn about jobs that fit you the best. And it's hard to know that until you start working. Um, Once, let's again, approximately at the time you reach 35, you will hopefully have moved into an industry or career that suits who you are. And one of the things I emphasize in my face-to-face classes, and I want to emphasize here, is you are not done learning when you graduate from college. You have a lot of learning to do on the job. I call that skill deepening. And roughly speaking, you can think of that maybe as the next 10 years of your work career. At that point, you may have settled into more of a steady, longer term job. But at that point, you're going to still be developing a lot of skills. Um, Sometimes, many of our students, at some point between, say, age 25 and 45, will go back to school and get a master's in some field. That might be in business, or it could be, say, a master's in chemistry or biology or in economics, something that pushes your undergraduate skills further out. For most workers, their peak earning period runs from their mid 40s into their early 60s. And so that'll be periods where you will continue to be developing more skills, but hopefully the investments you will have done in schooling, learning about yourself, and skill deepening on the job early in your career will translate into peak earning. And it's historically 65 was kind of an age we thought that people retire. I think for most of us, the way Social Security changes are look like they're going to be put in, you should probably think that you're more likely going to need to work to 67 or 69 until you can retire. But with this life cycle, you will have different earning trajectories, so different periods of time you will be earning different amounts, and also different savings possibilities. Another thing that Chapter 1 emphasizes is, as you think about financial goals, whether it's your desire to purchase a car, maybe purchase a house, maybe purchase a boat, maybe save for retirement, different financial goals are achievable within different time frames. And it's important, as you begin to think about setting up financial goals, that you learn how to classify them either as short-term goals, intermediate goals, and long-term goals. These ideas of classifying your financial goals into a time period is something that's reviewed and covered in Chapter 1. It's very important. Not every financial goal is a long-term goal. Retirement saving, long-term goal. Saving enough for a down payment for a car might be a short-term goal. Saving enough for a down payment on a house might be an intermediate goal. You need to, as you think of financial goals, you need to think of time frames associated with them. Other things that influence your planning, and this is where it really is impossible to have one specific plan for each person in the class or each person in your family, is that different issues affect different people. So in particular, different people have family specific issues that influence their planning, savings, and expenditure decisions. most prominently, health issues related to you and your family can greatly affect your ability to save, your necessary expenditures, and your ability to work. Um, that can come in the flavor of you and your partner's health issues. It can be issues related to your parents as they age and implications that will have and demands on you. And it also can relate to the health or the needs of your children. So you need to take these type of issues into account. You need to develop plans that reflect your own issues and demands, and uh, don't necessarily have to have the same financial plan as one of your best friends who maybe has a different set of family specific issues. There are issues, however, that do affect all of us more or less similarly, and that's macroeconomic issues. So these are things that affect the macroeconomy, and these affect not just your job and your income, but they affect savings incentives or spending incentives. So, for instance, inflation, which is the rising price levels, might change your desire to purchase an item in the time frame at which you do that, make that decision. Interest rates also can influence your desire or ability to purchase. Interest rates, when they're low, make, for instance, home purchases much easier. And so, as Chapter 1 discusses, these issues affect most people in the economy similarly. Finally, this issue of values is an important aspect of this class in personal financial planning. You need to think a lot about your values and things that you value. And in particular, I want you to think about why certain values are important to you. Things that you value will influence your purchase and savings decisions. That might lead some people to value, say, I really have a high value of a beach house, and other people would not have that. That might change things that you're saving for and how you spend your money. I do want to emphasize that in this class, and as you think more about personal finance and try to set up saving profiles for yourself, you need to fight the large push in society to purchase and consume a lot, right? Because it's the goal of companies is to get you to spend your money. That doesn't necessarily correspond to good financial decision making. You need to ask yourself, do you really need the next item that they're selling to us? Can your current computer still get the job done for the next year? Do I need a new car? These are all things that were marketed to us, and we have to really come to grips with, are these things that I really need, or somehow is the purchasing decision, why am I getting value from it? I'm not saying these things are bad to purchase. You just need to think hard about why you're purchasing them, because that influences your ability to do other things. Chapter 1 talks a lot about opportunity cost. When you choose to buy a new car, that means you're choosing not to do other things with your money, for instance. Finally, in the next video, and actually I already have a set of videos on the website, I'm going to talk about time value of money issues. So part of financial decision making is understanding the time value of money. There are 4 concepts I'm going to cover. One is simple interest. I'm also going to talk about a concept called future value, and that is, if you save a certain amount of money today, how much will it be worth in the future? A similar idea is something called present value, and that is if someone promises you something in the future, what is the present value, the current value of something, say that you'll receive 15 or 20 years into the future. And then we'll talk a little bit about loan payments. That's a very quick overview of ideas from chapter 1, and we will have another video on this time value. You should read the chapter and look at the slides that are available online. Good luck.